The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Micron delivers, but the question is at what cost? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. The S&P 500 very tepid right now. We've been bouncing back and forth all day, even with those Micron results that we got last night. You can see that enthusiasm has faded when it comes to the S&P 500, though technically we are still in the green. You can see a little bit more of that enthusiasm when you take a look at the NASDAQ 100, where big tech lives higher by about 0.8%. Also taking a look at the 10-year Treasury yield. Yields falling across the curve after we got that PCE data this morning, coming in as expected. Of course, an upward trajectory, but as expected, not worse than maybe some have been fearing. And you can see 10-year Treasury yield still holding below 440. And then Brent. Keep an eye on Brent, a developing situation in the Strait of Hormuz. Apparently a cargo ship has been attacked, so Brent, you can see moving higher on the back of that.
Yeah, that move higher, a big reason for the fade lower that you're seeing in stocks, despite the fact that Micron did indeed deliver. Qualcomm also delivered. But as you can see, that's not necessarily enough for the broader market, despite Micron being the 7th biggest weighting in the S&P 500. It's a lesson in concentration risk that sometimes means a rising tide. Sometimes it just lifts, well, one boat. The memory chip boom that has boosted Micron's quarterly profits 15-fold is coming at the expense of just about everyone else. Apple today said it's raising prices on Macs and iPads 15 to 20% to offset costs caused by that unprecedented memory shortage. Microsoft went further today, announcing a roughly 25 to 60% jump on those Xbox consoles. This all follows recent price hikes from Sony on its PlayStation, Nintendo on its Switch devices, and Valve on its Steam machines. In fact, while the market today took a look at that PCE report and actually cheered the resiliency in spending and that presumed transitory bump in inflation, I want to leave you with a reminder. The most inflated item out there isn't actually factored in to the CPI and PCE calculations. Prices on a category known as computer software and accessories rose in May by a record 14.5% from a year earlier. That means just because memory chips aren't weighted in the official inflation data, that doesn't mean that the weight of that chip inflation on companies and consumers alike isn't being felt.
It's a good reminder that what we see on the screen, the numbers that we get in these inflation data releases, they don't necessarily reflect the lived experience of consumers. But let's take a look at the inflation data since we got more of it this morning. Here behind me, we have all of the different readings. You have PCE, CPI, and PPI. PCE, which we got this morning year over year, that's highlighted in white here. But no matter which line that you're looking at, you can see that the trajectory has been higher, a bit of a bump up. PCE in particular on the headline basis rose by the most since 2023. But of course, when it comes to these monthly data releases, we know that they're a little bit stale. They're backwards looking. That's particularly true with this latest release. When you think about all of the developments that have gone on in the Middle East, the hope that maybe we could get to some sort of lasting ceasefire, you've definitely seen that reflected in the oil market. So, Romaine, the big question is whether or not this will be the peak for inflation and whether we could see the high water mark.
That is a big. Yeah, that certainly is a big question that the market is going to have to parse. So let's kick things off here on this Thursday afternoon with Olaolu Aganga, head of portfolio construction and analytics over at Citi Wealth. Great to see you again.
Thank you for having me.
I am curious about the economic backdrop here. And I understand you can take some of these inflation readings and you can certainly find a lot of good in it. You can certainly find a lot of bad. I am curious as to what you and your house view over at Citi Wealth is right now about exactly what this resurgence in inflation is. Should I be worried? Is this going to be potentially temporary, or is this something more structural that should be factored into equities?
Yeah, over the last couple of weeks, there have been a number of central bank meetings. Obviously, the FOMC last week, Kevin Warsh's first meeting. There are a number of things to think about. First and foremost, we haven't really hit our inflation target or been at target for 5 years, really? So that's a starting point. Then, as you start digging in deeper, yes, right now markets are pricing in rate hikes in order to be able to combat inflation. kept policy rates on hold despite that. But then if you start looking at some of the broader picture, first and foremost, for a macroeconomic backdrop, we don't have concerns about the labor market. That's pretty strong. The real economy is doing well. Consumer spending is good. Wage growth has been above trend. So broadly speaking, the macro picture is okay. Inflation has been ticking up, and that's been expanding in a number of categories, but we're not seeing a sharp rise.
I am curious, though, about just the state of consumer spending. We saw that in the PCE spending numbers that came in above expectations. We got an update on GDP. That was relatively strong. Anecdotally, we've spoken with a lot of CEOs. We're going to hear later from an interview I did earlier with the CEO of Casey's General Stores. He talked about lower and middle income consumers, at least in his view, still holding up. So why are people worried about the economy? Is this just sort of in their own head?
The inflation picture is very real, and a sharp rise in inflation could obviously trickle through to a number of factors. But you're right, we're seeing consumer spending and consumer sentiment actually doing pretty well. On the flip side about it, if you were to look at some of the other key indicators, money market funds, treasuries, bank deposits, all of that has actually been a decent amount of the household balance sheet. So consumers have cash as well, closer to around 12%. That is both for the real economy, and then at the same time, as we look at markets, which is our focus over at Citi Wealth, we're mindful of any type of dips. There's a lot of money sitting on the sidelines to be able to buy the dip.
Yeah, and that's what I wanted to get to. You know, when you think about all these different cross currents in the economy, how does that inform how you put together a portfolio right now? And it sounds like what you're saying is that buy the dip impulse, it's very much alive. Is that, you know, sort of a broad-based assertion here, or does that only really work when you're talking about, you know, big tech, for example?
Well, I mean, if you were to look at just broader market since 2020, if you were to go from trough to peak, the dips have been shallower, they've been faster, they've been narrower, and from trough to peak, it's been about 11 days. So it's a much shorter window. Now, what that means is you could miss the dip opportunities. Your window to be able to get in there is not the way it used to be historically, and not being invested can really be costly. So we're talking about that, but then at the same time, we just came off Q1 earnings. They were incredibly strong. So equity markets has been doing very well. Of course, technology, of course, AI, we saw that broadly across the board in consumer, some of the consumer areas as well in financial. So that's been broadening out. Now, the macroeconomic picture, the healthy cash on the sidelines, delivering on the earnings growth. For us, it's about the fundamentals, and the companies have been delivering. We prefer equities over bonds, frankly. So we still like risk assets here. As I said, the drawdowns have been narrower and less steep than they have been historically, but we are cautious. This is not an environment whereby we can be complacent. There are complacency signals out there because the markets have been more resilient than we've expected, frankly.
All right, Olaolu, I'll leave it there. Great insights and great to have you back on the program. Olaolu Aganga, head of portfolio construction and analytics over at Citi Wealth, as we count you down to the closing bell and take a look at Moderna getting a shot in the arm as an advisory panel here in the U.S., potentially clearing the way for that company's influenza vaccine. An exclusive conversation with the CEO when we come back after the break, right here on The Close on Bloomberg.
Moderna's flu vaccine clearing a major regulatory milestone, on its way to becoming the company's third approved product after winning over the FDA's outside advisory panel in a unanimous vote. We spoke exclusively with Moderna CEO Stéphane Bancel earlier on the heels of the company's Science Day to hear about his hopes for the vaccine and the rest of Moderna's pipeline. Here's what he told us.
Last week, we were very happy to have the advisory committee of the FDA voting 9-0 in favor of a recommendation for a vaccine. Now, of course, everything is in the hands of the FDA. Our teams are on almost daily communication with the FDA working team to get the product moving forward. So we are cautiously optimistic that we should be able to finalize this.
And assuming that you do get that final approval decision from the FDA itself by August 5th, that would be just in time for the next flu season. It seems like the consensus out there, though, is that this flu vaccine wouldn't be impactful for your revenues until 2027 or so. So what are you modeling for in Moderna? You know, when do you expect to see sales from this actually meaningfully hit your bottom line?
Yes, so basically when we launch a product, because it's mid-season and because there's still uncertainty because it's not approved yet, we don't put that into the guidance for the year. We're still going to work on launching the product this year. As you know, the retailers, the pharmacies, have to order products from all the manufacturers before the season to be ready to have product in stock to vaccinate people. So we don't expect a big season, but it's going to help us to oil the machine to make sure people are well educated about the product. As you know, it's not an egg-based technology, it's mRNA-based technology, allowing us to have more precision for the strains circulating in the US. And we think that that's going to have a huge impact on vaccine efficacy. And so all that education is going to happen this year. And as you said, we expect this to be a meaningful contribution to our growth in 27.
I am curious, though, Stéphane. I mean, even if you do get the approval on August 5th, last time I checked, we still don't have an advisory committee in place on immunization, which, of course, would be the primary pathway to getting the insurance pickup. If for some reason there is not an advisory committee there, what options do you have to make sure that this vaccine is actually covered by insurance in the U.S.?
Sure. I mean, if you look what happened last year with COVID, it was kind of a similar situation in terms of timing of launch versus timing of the advisory board. I think a lot of states have decided to go their own ways in terms of making sure vaccines are available to protect their populations. So we'll be working with the federal government, of course, as always. We'll be working with states as well and with retailers to make sure that products are available.
Is there a sense, though, particularly through the lens of Wall Street and their expectations for the potential impact on revenue, is there any risk that you miss out on this flu season coming up?
Yes, I mean, there's always risk, of course. First, the product is not approved yet. But as I just mentioned, this is not in the guidance for the year. So there's no downside from a sales guidance standpoint because we have put zero for flu this year.
And I do want to talk a little bit about your relationship with the FDA. You and I spoke at the beginning of May, and since that time, FDA Commissioner Marty Makary has vacated that role. We also saw another top FDA official, Vinay Prasad, leaving the FDA as well. And I wonder what that has meant with your relationship with the agency. Has it changed? Have you noticed a direct impact of that change, particularly since Commissioner Makary left?
So if you think about the FDA, most of our interactions are from the Moderna working team to the FDA working team. That's the teams that are making the review happen. It's not specific to Moderna. It's how the industry works and has worked for many, many decades. And so if you think about it, those leadership positions you described are already in charge of new policy. So while those jobs are vacant, what's happening for the countries, there's no new policy to move the agenda forward. But for a program standpoint, for Moderna specifically to your question, there is no impact. The FDA working team is made of professional doctors, scientists who are working actively and reviewing the file. They are talking to our teams if they need more data, if they have more questions. And that process is going regardless of the leadership situation.
I hear what you're saying, and especially when it comes to, this isn't just Moderna. And to that point, I mean, we have seen some pretty interesting reversals coming from the FDA when you think about decisions that have been made on rare disease drugs such as Huntington's, a drug coming out there, or rather a decision reversal. We also saw a reversal when it comes to a rare child disease as well, which will now be resubmitted just weeks after it was rejected by the FDA. So I'm curious, I mean, in your view, and it's early days, but do you think that there is a bit of a thawing of the hardline attitude that the FDA under Makary had taken towards some of these drug study designs?
I mean, if you look at our own situation, as you know, we had a refuse to file letter, which was a huge surprise earlier this year. Our team had met with the FDA last year to discuss the flu file and say, can we submit it? And we got the answer back, yes, you can submit it. We did submit it in December, and then we got the surprise of a refuse to file letter. As you know, this was resolved over time. And again, with a positive advisory vote last week, we're optimistic. So I think as we get the system working, through the working teams looking at the science and the data, things are moving forward, which is great for patients.
Stéphane Bancel there, the CEO over at Moderna. That was just part of our interview. It was much longer. He touched on a few other topics. You can watch that full interview over at Bloomberg.com/videos, Katie. And we should point out the shares down today. There was a little bit of front running into this. The shares had rallied over the past couple of weeks, kind of in anticipation of this. There's still one more hurdle. They still need the final FDA approval. And again, that advisory committee has to effectively sign off on it. But he seemed pretty confident that this is kind of a done deal.
Absolutely. And even though, I mean, again, as we heard from Stéphane Bancel, this wouldn't really hit their revenues until 2027, but a fantastic year for Moderna shares, higher by 99% year to date on a total return basis. Of course, they've had a rough ride since the COVID era sort of passed by, but obviously a needed good news here. Yeah,
we talk about that mRNA technology and the idea that for a while it was a one-trick pony. Everyone said, how do you sort of build off that COVID vaccine and really turn it into a much broader business? Maybe this is the path forward. Speaking of diversification of businesses and the path forward, Qualcomm trying to do the same. The company that is probably best known for making chips for handsets and cars says, well, it can be a big player in the data center space. We had a chance to catch up with the CEO about what he's telling investors. That conversation coming up next, right here on The Close on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. Let's start with Keurig Dr. Pepper. Barclays citing compelling upside for the beverage stock, upgrading to overweight, taking the price target to 36, saying that while the story is still complex, better leverage and reduced uncertainty create a better runway for a re-weighting. Those shares up a second day. Next, let's take a look at Workday. The software stock upgraded to buy over at Monnez Crespi, $150 price target. The analyst calling the current valuation enticing, particularly given its potential in the AI era. Of course, one of the reasons why the valuation is enticing, the shares are down 50% so far this year, including a 3% drop today. And finally, let's take a look at Qualcomm. Morgan Stanley, which dropped coverage of the stock late last year, then reinstated it earlier this year with an underweight rating, now says, forgive us, we were wrong to be skeptical about this stock, raising it to equal weight, putting a 231 price target. This after Qualcomm's Investor Day, where the CEO talked a lot about it will be a beneficiary of the AI data center race. So shares up about 4% on the day, as investors do seem to be warming a bit more to Qualcomm's diversification story. The idea that by 2027, it can be a more meaningful player in the data center space, and a partnership with Meta that is expected to potentially start generating revenue in 2029. I had a chance to catch up with Cristiano Amon, the CEO of Qualcomm, along with Bloomberg Tech co-host Ed Ludlow. Here's what he had to say.
$5 billion in fiscal 27. It's a high confidence number that we have based on customer engagements we have right now. Most of the revenue is from custom ASIC engagement that expanded since the acquisition of AlphaWave. And you started to see in their revenue some of this innovative technology we came up for accelerators that doesn't require HBM memory, is our high bandwidth compute. And as we keep executing on those customers, we're excited to see that revenue going to about $15 billion in fiscal 29.
I am curious, Cristiano, when it comes to those longer term targets and the bridge between the short term, so what you have put out there for 2027, is there any sense, I know you haven't named the customers that get you over that bridge here, but is that going to fill the hole of that $5 billion based on the $1 billion that we already know is out there?
Look, the $5 billion, as I said, it's, I'll give you the composition. I think what I can say right now, I think, as you'd expect, a lot of those contracts are governed by non-disclosure. We have one large hyperscaler customer in the United States, one large hyperscaler customer in China, and then we have some other engagements that we had on a data center. That is all into the $5 billion. So the $5 billion it's a very high confidence forecast to which we have the customers, the capacity, the memory allocation, and everything. As we think about the engagement we have today, and also we talk about a contract that we have with Meta, also for 2 generations of the CPU, especially as we position ourselves for the agentic CPU opportunities, that those engagements are into the $15 billion number. For Qualcomm, as a new entrant, those are great numbers, but really, when you look at the scale of what's happened in the data center, you would imagine as we execute and we show our differentiation, there could be upside, but we're just, being focused on the engagements we have today.
I do have to ask, though, and investors seem pretty pleased with what they heard yesterday about you articulating this longer-term data center strategy. But I'm curious, I mean, you famously exited the data center business back in 2017, 2018, and I know there were a lot of reasons for that went beyond your operational control. But there was a lot of competition then. There's probably even more competition today. Why do you think you can get it right now compared to what it was 8 years ago?
Yeah, look, the circumstances, I think, when we started on the CPU, actually, I know people talk about data centers as a general term, but we started a long time with an ARM-compatible ISA CPU very early. There was a big software barrier. This was before AI. And, at the time, I did not, the market wasn't ready for it, only until later. So it was kind of probably the right decision for Qualcomm at the time. This is a different conversation. It's a different data center right now. This is about AI. But it's a valid question, right? So I will give you the same answer that I gave when we entered the automotive business, when we entered the industrial business, and everything that we have been doing to diversify the company. Those are fast-moving markets now, changing with technology. So where we really focus is not what the data center is doing today, but what the data center is going to be doing tomorrow. The data center is now moving to agentic. That's why you see CPU companies on the rise. You see demand on the rise. The data center is being disaggregated. It's not one single GPU that does everything. You have different hardware. And we're coming out with a comprehensive portfolio. We have a CPU. We have a new memory solution that is not a memory from the memory provider. It's actually been designed by Qualcomm that doesn't require HBM. We have a different accelerator for the disaggregated compute, and we have our semiconductor scale, which is good for custom ASICs. So that's what we're doing. And if technology matters and you have fast innovation cycles, there's room for Qualcomm.
And our thanks to Qualcomm CEO Cristiano Amon. To watch that full interview, you can head to Bloomberg.com/videos. Very interesting conversation there on Qualcomm. You can see that shares are higher by nearly 5% today. I can't say the same for Apple, though.
Yeah, I'm actually intrigued by this Apple story. I mean, we kind of knew they were going to have to raise prices, and they came out. It's a big hike.
Yeah,
yeah.
absolutely.
I mean, we're talking like 15-20% across the board, and the shares are down on it.
Yeah. Well,
I guess they assume nobody's going to buy a new iPhone.
We're going to try to answer that question next. Stick around. We're speaking with Lindsey Bell after the break.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on the broader market right now. The S&P 500 slipping into the red, and one of the big losers on the day is Apple.
Yeah, this is kind of a fascinating story. And we should point out, Apple actually started the month of June at a record high. June 2nd hit a record high. It's down like 12% or so from that. And I think as of today, it's basically back to its lowest levels from last year, like kind of April of last year. And apparently this has to do with maybe the fact people aren't going to be buying iMacs and HomePods and all that.
Yeah, maybe because costs are going up, prices on those products going up. Perhaps not a surprise given we saw those blowout numbers from Micron last night. So let's dig into it a little bit more. As you can see there, Apple shares now down by 5.6% after the company hiked prices on various products to offset memory shortages, saying that it's working tirelessly to find solutions, with the price of the MacBook Pro, for example, rising to $1,999. Let's unpack this story with Lindsey Bell. She is Chief Investment Strategist over at 248 Ventures. Lindsey, great to have you with us. In some ways, this feels like Micron's gain is Apple's pain when you think about, how explicitly the company called out memory costs.
Yeah, no, I completely agree. And actually, I think that the Apple stock price reaction is sending a signal that the rest of the market might not have gotten today. And to me, it says this could be the first sign that the AI bubble could potentially be starting to deflate. And I don't say that lightly. I say that in a market that we've been in that rewards margin expansion and at the very worst, margin maintenance. And price increases have historically been celebrated in the more recent years versus being punished. And so this is the first time we're seeing shareholders react in a negative way to price increases. And you have to remember, these prices increases aren't even on the iPhone yet,
right, which
investors are realizing is coming in the fall. You know, that was going to be okay because AI was going to be integrated into the iPhone. But now the question is, it seems to me that shareholders are worried that the consumer can't absorb these higher prices.
Yeah, potentially really interesting sign of the times here. And talk us through potentially what that looks like. You mentioned that this could be one of the first signs that we're starting to see the deflation here of the AI trade. But what does that daisy chain look like in your view?
Yeah, no, I've been thinking about this today quite a bit. And really what I'm seeing is Tim Cook probably was trying to do, you even said it, everything he could to prevent these price increases, because these are not insignificant price increases, right? So he had no other choice in my viewpoint, right? But shareholders worried about the consumer taking the stock price down. So to me, that says we've reached, which I've been watching for a long time, price elasticity of demand.
Yeah.
When it comes to memory chips. Memory chip price have increased they've increased 4 times, quadrupled over the last 3 quarters alone. So that says that potentially semiconductor price increases are going to have to slow, which these companies, as we well know, are supply constrained. So the question is, how is this going to impact revenue for them in the near term? And how does a slowdown in revenue, even if it's just minimally for these companies, how do shareholders react to that? Because as we know, investors like to see growth continue to moving higher. Even if we move from, double-digit revenue growth to less double-digit revenue growth, are investors going to be okay with that? So that's just a semiconductor side. And I think that it also says that we're reaching a point where we need other companies, because real money is being made by the data center build out and the sale of these chips, right? Yeah. And it's not just in the tech space, it's in industrials, it's in a bunch of different other sectors. But we're going to have to start to see an ROI on this AI spend and investment. Right. Where is the productivity gains? It can't just be coming from employee cost cuts.
Right. So I am curious, Lindsey, when we start to talk about what options some of these companies have on the table, it's obviously not just Apple. I mean, it's a lot of behemoths. It's Sony, it's Microsoft also today said price hikes as much as 60% on some of its products. We've heard from a lot of other consumer-facing companies, the consumer electronics companies. These are companies that are relatively deep pocket and I think would have some optionality. I know you can't just create a memory chip out of thin air, and you just can't build a new memory chip plant overnight. But I am curious, is there any way that these companies can maybe protect their sales and maybe even their margins in the interim, even if that does mean that they might not necessarily get relief on the actual memory chip price that they have to pay?
I think they've been taking a lot of action to protect their margins in the last several quarters. I look at Intel, and they talk about how they've been less focused or reducing their focus on lower price, lower margin PCs and focused on the higher price, higher margin PCs that integrate AI, because that has been one of the price actions that they've taken to maintain margins. So I think Apple has even done that. That's been their strategy, is to remove lower price products with lower margins and focus on the higher price, higher margin products. And that's why I think this move by Apple is significant. And others, you're right, others have made the same announcement today that they're increasing prices because they have no other choice. I think we've gone too far with price increases on the semiconductor memory chip. And I think if we reduce them or a little bit, everybody could still win here. Well, it doesn't have to be a winner take all.
Right. So that's my other question here, Lindsey, is that why would we maybe not see Micron, SanDisk, even some of the CPU and GPU makers actually provide some relief? I know that would be at the expense of their margins, but for this market, and certainly for this rally, this has largely been a revenue growth story. I know the margins and the profitability matter, but if Micron would say, look, we're going to sacrifice maybe a couple of quarters, we're going to go from a 1,400% jump in profitability to maybe just a mere 900% jump. Can you live with that, investors, for a couple of quarters until we sort out this market?
I could live with that as an investor, but it's all going to be about communication. You guys know this so well, that they're going to have to, the IR team is going to have to work overtime to really communicate that change in strategy. And I think investors can get comfortable with it because the demand really is there. We've just hit the price elasticity, and we can still have really good and robust margins at prices that aren't exactly where we're at today. So I think it's just going to be a communication and a strategizing among leadership and really making investors feel comfortable with that, because these are still going to be some of the companies with the greatest growth, even if they moderate pricing increases. It's good. They're going to have the best and greatest margins in the whole S&P 500. And a lot of these companies still have really good cash flows. So I think it's not something that we throw out with the bathwater, but I do think we've hit price elasticity of demand here, and that worries me.
And Lindsey, we only have about a minute left, but I mean, you think about, some of the companies, Apple included, we've gone through a lot of them that are dealing with this surge in memory costs. I mean, how much does this increase the urgency for them to sort of find a solution around it? Something I keep thinking about is AMD's recent acquisition of a company, I believe, called Mext, basically trying to work around some of these memory issues. And, you could imagine a scenario where we see more of those types of deals come through.
Yeah, no, I think that the opportunity there is in M&A, and I think that there is opportunity in finding any way possible to maintain margins. I think the companies that can do that and have the opportunity to do that will be rewarded. But I do think that a lot of these companies have spent the last several quarters focused on that. They saw this coming. I think the geopolitical environment also had people on edge. We see some of the supplier data, the manufacturing supplier data coming out with prices increasing. So this actually isn't really a surprise. Let's just hope that they don't have to implement more price increases later in the year.
Lindsey Bell, Chief Investment Strategist at 248. A closer look at shares of Apple having their worst day since basically Liberation Day sell-off back in April of 2025. Meanwhile, another stock selling off is Hertz. It dropped 40% yesterday. It's down again today. We're going to talk about the dilution that it's about to deliver stock investors. That's coming up next here on The Close, right here on Bloomberg. Time now for our stock of the hour. Taking a look at shares of Hertz, the stock which yesterday had a record one-day drop, extending those losses today as it sets up now for its biggest weekly drop since relisting back in 2021. A lot of concerns about a slowdown in profitability, as well as stock issuance, a bond offering. And, of course, the idea that it might be undershooting analysts' expectations. Bloomberg TV markets correspondent Nora Melinda joins us right now to talk a little bit more about this. All right, so let's just go back to the other day and set the scene, because this all started off first with a profit warning, something about the used car market being soft, and then it just kind of compounded from there. What's going on?
Absolutely. So this has been a company that's already been struggling, given the backdrop that we've been seeing in the economy. Of course, oil prices, travel, a little bit softer. And as you're mentioning, just the used car market, really just a soft space as of late. So that's really been a challenge for the company. Of course, we know this is also a company that just emerged from bankruptcy back in 2021, trying to get back on its feet. If you take a look at how the stock is doing so far year to date, down about 51%. Now, what's really driving this latest decline right now is the fact that the company is having an unusually complicated, I should say, financing structure that they have going on right now in terms of trying to tap into the debt market. Yeah. And that's what's really spooking investors right now, because it's making investors on Wall Street think, is this the only way that they're actually able to raise money?
Yeah.
Right. Well, walk us through that a little bit, because you're seeing a stock issuance and a bond offering at the same time. Our colleagues in Bloomberg News describe these shares, though, as shares that are meant to be shorted. So, as you said, it's complicated, but how exactly does this work?
So they're wanting to raise $100 million in stock, separately $300 million in convertible notes. Now, this is a stock that we know nearly 50% of its shares are already sold short. Now, in this scenario, it essentially is now issuing securities that actually facilitate even more shorting as part of its financing. And that's why investors are concerned. Now, we've seen more than, $600 million being raised in just one day from investors that are shorting this stock. So what is essentially the head scratcher here for a lot of people on Wall Street is why would you want to have a financing scenario in which investors are still able to short the stock even more?
That's what I'm curious about. I know they obviously clearly have to do this, or they wouldn't. I would assume they wouldn't. That's an assumption. But it gets to this idea, though, too. And you go back to that 2021 relisting. The idea they got hurt by the pandemic, as every car rental company, every travel company out there. I thought they were doing relatively well for a while, and but I mean, I was looking at the shares. I mean, they're what at like $2 or $2.50 right now. They relisted back at 29. They were like at $8 a while ago. So there's been a steady decline in the shares leading up to this week.
Right.
And I am curious, did something go wrong other than just what we learned over the last couple of days with regards to, the share offering, bond offering, et cetera?
Well, the situation with Hertz is it's not necessarily exclusive to Hertz. If you also take a look at the performance of its peers, you have been seeing the used car market really struggling as of late. Interesting, because just back in 2021, that's when I bought my first used car from Hertz. From Hertz.
Oh, wow.
That's where I got my first SUV back in Virginia, not here, of course. But that being said, we've been seeing a lot of other companies like Avis included. If you take a look at their share action, down about 6% on the day, but they are doing pretty strong year to date, up about 30%.
All right, Nora,
Did Tom Brady sell you that? Remember when he was doing the whole
I do remember that era.
Man,
how did that work out? Those were like EVs.
That was a moment in time.
Did you buy an EV?
I didn't, no.
Well, Nora
You know he's
Melinda,
selling GLP-1s now.
They are. They're selling everything these days.
the close is up next. We'll take you there with Stephanie Aliaga. This is the close.
Welcome back to the close. Romain Bostic here with Katie Greifeld. We had a relatively strong opening for the markets on this Thursday afternoon. The NASDAQ 100 was up more than 2%, largely because of those earnings that we got overnight from Micron. But a lot of those gains, at least for the broader market, have faded.
Yeah, it's interesting. Those session highs feel like a long time ago. It's a really interesting breakdown when you take a look at the S&P 500 because you do have Micron absolutely soaring. So too is SanDisk and Applied Materials. But then you look at the losing side of the ledger, and it's a lot of big, important names. I mean, Apple, NVIDIA, Microsoft, Amazon, Meta, all lower today, all dragging the index down, even though you do have more winners than losers right now.
Yeah, absolutely. In fact, the entire sort of Mag 7 universe is basically in the red on the day. And then you have the geopolitical issues bubbling back up. There was a report, you mentioned it at the top of the show. Apparently, a ship was hit in the Strait of Hormuz, raising a lot of questions as to is all that oil that we had started to see flowing out of there going to now get clogged back up?
Well, that's the thing. I think there's still some disagreement. They're trying to figure out who exactly is responsible for it. But, I mean, no matter who is, you have to imagine that some of the super tankers who had been waiting to cross the strait maybe are going to be a little bit more hesitant now.
But it was something was hit, right?
A cargo ship.
It's just a matter of who did it.
Who done it?
It's like if somebody hits you, punches you on the subway. I don't really care who did it. I just care that
Maybe I don't want to ride the subway anymore.
Yeah, don't ride the subway. It's sorry.
Take the path.
All right, the path. All right. Well, let's take the path to the closing bells here. Just about 9 minutes away. Stocks at least trying to hold on to some of the gains, at least when it comes to the NASDAQ 100 as well as the Russell 2000. Of course, the longer-term trajectory of this market. Some big questions as to whether it's still intact. Stephanie Aliaga joins us right now here in Studio 2, global market strategist at JPMorgan Asset Management. Stephanie, great to see you.
Thanks for having me.
We talk about the AI trade, and I don't think anyone doubts the long-term trajectory of that. But obviously, I think as what we've seen over the last few days, there are a lot of concerns about whether we are hitting a little bit of stall speed here. The idea of what we heard from Micron last night, which was phenomenal. But for every extra dollar Micron is able to charge for those memory chips, that's coming out of somebody's pocket. And we learned that in a big way from two announcements from Apple and Microsoft, which said they had to raise prices on a lot of their consumer products to compensate.
Yeah, no, absolutely. I mean, we've just seen this whipsaw in markets around this AI narrative, and I think we're going to continue to have this debate around the economics of AI. But what was made so clear from this Micron report following what was a really robust first quarter earnings cycle is like the overall pie of AI demand is growing quite fast and is getting quite large. I mean, 2 years ago, even last year, the big concern was where is the adoption going to come from? Who's going to pay for all of this? And this year, we are learning that enterprises are becoming massive consumers of AI. They're blowing through their planned AI budgets in the first quarter, and they're expecting to continue to spend and upgrade their spend going forward. So that, on top of the demand that the hyperscalers are receiving, I mean, Is cost inflation a risk? Yeah. Yes, but it seems like it is still a worthwhile, investment for these companies.
Well, you raise a good point too. I mean, we mentioned Microsoft and Apple, and obviously we're talking about the input into a physical product, which they can't really get from under that. The other side of the AI story is the potential productivity enhancements. As you said, companies adopting it, maybe they find ways to improve their margins as a result of that would offset whatever increase in costs. We haven't necessarily seen that though show up in the earnings reports. I know it's still kind of early. Do you think we'll start to see that in the next couple of quarters in some sort of material way?
It's hard to say, just given how challenging enterprise adoption actually is. Like, it is a lot more than just giving your workers some cloud code subscriptions, which even deciding that is very difficult for companies, right? There's all these risk factors to consider. There's this question around compute costs, and there's this reality that you need to retrain your workers and reorganize workflows. With that said, eventually, I think what we're seeing in just the raw usage of these models that you see in small firms does point to a pretty big pot of gold on the productivity front once businesses figure out how to use this technology and how to integrate it. Whether that shows up in 12 months or whether that is a longer-term structural theme, I think is going to be a big question. But the companies that are leading the way right now, that are fastest and particularly smaller, more nimble, more tech-savvy firms, I mean, you are seeing that in their ARR growth, right? Unprecedented rates. And I think that's a really telltale signal of the use cases here.
So how do you put this into a portfolio? Because, you make the good point that the overall pie of AI demand, we're watching it grow in real time. But then you think about these very real bottlenecks that some companies are running into, memory, the most urgent example right now. And when you take stock of all these different cross currents, I mean, where does that leave you in terms of, your sector, your industry allocation?
Yeah. Well, in this market, when these bottlenecks are running so acute, you're seeing new entrants really enter the market. So that picks and shovels basket of companies has continued to widen and evolve. And so we see opportunities not only in these high-flying memory names, but in even like enterprise software, right, which has not been doing quite well this year, has become a lot more bifurcated, where some companies that can maybe help you specialize in model routing and being efficient with your tokens are benefiting. We think that in terms of also specialized AI, so if you are running a healthcare AI system and all you're doing is healthcare, you might not actually need to consume as many tokens as a general purpose model. So there's some interesting ideas, I think, outside of some of the popular narrative here, still within the AI space. And then you also have to consider that some of these industrials players or even like private infrastructure, they operate in your portfolios in different wrappers. So looking for exposure, but with some defensiveness, with not as high of a beta as some of these concentrated tech names is also an interesting way to gain access to the theme, because the theme is still really exciting, but you want to make sure you're not getting over your skis in portfolio concentration either.
And of course, I mean, we're talking mostly in the context of public markets, but what does this story look like in the private markets, outside of the realm of what's going on public stock exchanges and in the public debt markets?
Well, it's really exciting. I mean, we have had this just accumulation of so much value in private markets, particularly because of these few behemoths, right? And this year, we think that a few of those IPOs will be big clearing events and potentially help rechannel investment within that private market ecosystem, where there's a lot of really exciting value to be made in companies specializing in AI semis, AI, business-specific applications, and even some challengers to some of these, current software players and so forth. So we think that's an exciting opportunity. Of course, the challenge is access, right? So you want to make sure that you're invested in with a company, with a fund that can achieve some degree of diversification in private markets too, because valuations there are also running quite hot.
Stephanie, always great to have you. Stephanie Aliaga, Global Market Strategist at JPMorgan Asset Management, counting us down to those closing bells. We're just about 2.5 minutes away from that, Katie. The NASDAQ 100 up about 0.6%, though it was up almost 3% earlier in the session.
Yeah, absolutely. So still benefiting from what we're seeing when it comes to a lot of these memory chip makers. But again, it's so interesting to see Micron leading the charge on the gain side of the aisle. And then you take a look at who's losing the most today, and it's Apple in terms of points.
Absolutely. We're going to walk you through all of today's market action, big moves in equities, big moves in oil. A full breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld taking you through to that closing bell. It's a global simulcast. Carol Massar, Tim Stenovic to join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube here on this Thursday afternoon. A Thursday trading session, Carol Massar, that started off really encouraging on the back of some good earnings out of Micron, an interesting investor day by Qualcomm, but a lot of those gains fading into the closing bell.
Yeah, and I think it doesn't hurt that once again we're talking about the Strait of Hormuz. We had a ship struck there as an oil supertankers were turning back again. There was a ship hit by an unknown projectile in the Strait of Hormuz, as according to UK maritime trade operations. We saw WTI crude also spike once again, going up as much as 3% above $70 a barrel, still up about 2.4%. Just a reminder that we haven't kind of tied everything up when it comes to that war between the U.S. and Iran. Yeah, a good reminder of the macro affecting the trade as well. Romaine, I want to go back to what you said about Micron and the memory chip makers pushing indexes higher. It's interesting seeing that play out when you have pretty much every name in the Mag 7 lower today, led lower by Apple as a result of them coming out with those price increases. Yeah, I mean, basically 15 to 20% on a lot of those iMacs and HomePods. Don't forget, Microsoft actually reported that it was going to raise prices on its Xbox. Yeah. So some of their models as much as 60%. And then I was just going down the list. I mean, it's a who's who of consumer electronics companies, from Lenovo to HP to Sony with the PlayStation to Valve with the Steam Deck. Fortunately, Carol already has the new PlayStation and Xbox. Well, you know, I hope so. Otherwise, it's going to be an awful Christmas for a lot of kids, and adults for that matter, too. But nevertheless, we talk about this idea that one company's benefit can be another company's loss. On the day, we're seeing a lot of losses across the board. The Dow Jones Industrial Average is holding on to some of its gains here. It is up about 70 points as we wait for these numbers to settle. That's going to be about 0.1%. Interesting on the S&P 500, it had oscillated between gains and losses for much of the day. It looks like the closing number is going to be 73.5801. That basically is unchanged on the day. The NASDAQ composite is going to close in the red, down about 0.5%. The NASDAQ 100 will close in the green, up about 0.8%, even though it opened today more than 2%. And the Russell 2000, Carol, adding 21 points, or 0.7%. All right, like I normally do, back to the S&P 500 we go. Those large caps, Katie, you've got, despite kind of a meh day, it feels like, certainly for the S&P 500, when all is said and done here at the close, you still have 305 names to the upside, gaining ground on this Thursday, 198 losing ground.
Yeah, it's a really interesting breakdown when we think about the haves and have-nots, and all of it adding up to the S&P 500 finishing pretty much unchanged on the day. But when you take a look at the sector level, you had 6 sectors managing to finish in the green, led by industrials. Healthcare also having a pretty good day, materials too. On the other side, though, in terms of what didn't have such a great Thursday, consumer discretionary down about 1.7% as a sector. A lot of that comes down to what we were seeing in TJX, rock stores, and consumer staples as well, Carol. All right, so let's go to some of the individual gainers. And I got to talk about Micron. Closing at, I believe, a record here today. The stock finishing with a gain of about 15.7% at its highs. It almost hit a 20% gain, so backing off some of that. We know surging here after the company issued a quarterly sales forecast that exceeded Wall Street estimates, signaling that an AI-fueled growth run remains strong. It has secured 16 strategic customer segments, agreements, which suggest that the company can kind of mitigate what we often talk about in the semi space, the boom and bust cycles that have plagued, in particular, the memory chip industry. This stock is now up about 328% year to date. So check out all the superlatives in terms of the numbers when that company reported. So that one was higher. Another chip name in the space, something that Romaine actually caught up with the CEO at Qualcomm today, along with our Ed Ludlow. That stock also rallying at its highs, up more than 11%, finishing the day with a much smaller gain, but still up about 3.7%. That's after the chip maker forecast annual sales of more than $15 billion from AI components in data centers by fiscal 2029. There's a lot to that report, but be sure to check out
the interview that Ed and Romaine did with the CEO, Cristiano Amon. Really good stuff there. Hey, I also want to just show you the Philadelphia Semiconductor Index. No surprise to see that average, thanks to Micron and Qualcomm and others. It was up about 3.6% in today's session. You had 21 of the 30 names in the index higher for the trade. So just something to point out there. Hey, and then for something different, I just want to take a look at airlines. If we flip on over to that board, and that group up almost 5%. If you look at the S&P Super Composite Airlines Industry Index, finishing the day with a gain of about 2.2%, rallying for 5 days in a row, up about 13% in that time frame. I also want to bring up JETS, the U.S. Global JETS ETF, which is a bigger picture of the global airline space, and that one was up about 1.5%. It's something that you really look at when you want to look at the biggest airline stocks. It has moved up to its highest level since September of 2018, outpacing the S&P 500 year to date. But keep in mind, the index has gone barely nowhere since the end of 2019. But nonetheless, moving up today. And of course, we know a lot of it has to do with it looks like things easing between Iran and certainly the U.S. We've seen energy prices come down. But again, today, we were reminded, ain't all over yet, everybody.
The question is, what is the path forward for mega cap tech? In fact, every single name in the Mag 7 was lower today. I want to home in on Apple. Shares of Apple having their worst day going all the way back to April of 2025. You guys remember that? Yeah. That was post-Liberation Day, when shares of Apple actually fell more than 6.12%. That's how they closed today. What was that?
I was sitting right here.
I was sitting right, well, here, but in a different studio.
Exactly there?
Not. I guess Romaine was exactly there.
Were you really there?
Everybody knows the story right now about Apple, and that's its hiking prices on Vision Pro, home devices, iMacs, iPads, and some other home devices because of that memory chip shortage. We talked to Mandeep Singh of Bloomberg Intelligence a little earlier, and he said there has to be demand destruction with a move like this. If you raise prices 15 to 20%, and you're selling the same thing, you're not going to sell as many of those things. So that's just economics 101. Shares of Apple getting hit today to the tune.
I do wonder, just not to be pedantic, but do you think, because some of these price hikes don't take effect for a few weeks, do you think there's going to be like a rush to buy?
Yes, I do.
Maybe we see,
I think there absolutely will be. Kind of like there is, a lull ahead of a new iPhone launch in September. So yeah, I think consumers are pretty smart about this stuff, and Apple's also really smart about when they time these things because the fall is the most important selling period ahead of the holiday season. Hey, speaking of the AI boom in chips, Cerebras Systems, keep an eye on this stock. Shares tumbling today, falling to the tune of 7.5%, although it was lower. It was on track for a record 2-day session loss. The company did give that disappointing annual sales outlook. That wasn't yesterday. That was the day before. It fell as much as 12% intraday today, traded at its lowest level since its May launch. Shares close to 50% below that record high of more than $300 that was hit on its first day of public trading. At that time, it was before SpaceX, so it was the largest IPO of the year. And finally, we haven't been talking about this that much, except on the crypto show. Look at what Bitcoin has been doing. And when Bitcoin moves, Strategy, the company formerly known as MicroStrategy, moves. Bitcoin taking a tumble today. Shares of MicroStrategy down today by 9.4%. Fears are growing that the Bitcoin buying machine is beginning to seize up, fueling the latest leg of Bitcoin's sell-off. Strategy shares down today by 9.4%.
A quick check in yields, a little bit of, let's just say, low volume, low activity there. A drop on the 2-year yield by about 2 basis points, a little bit higher on the 30-year yield, up about 2 basis points, as, of course, more focus right now on the micro rather than the macro.
Hey guys, not sure what maybe you're doing for the summer, or if you've got kids and maybe what they need to do for the summer, but Alpha School offering... Alpha, like, like an alpha dog. You know what that is, right, Romaine?
No, go ahead.
Alpha School is offering summer classes in the Hamptons, teaching academics with AI and afternoon activities with guests like chefs and athletes, $4,500 a week. Easy
to do
peasy.
what? I'm sorry? You just hang out with chefs and athletes?
No, well, you're learning AI also. Academics with AI. Apparently they're leading.
Is it being taught by AI or is it being taught by humans?
No. I think they're teaching it to kids.
Okay.
Why do you get so
I'm actually relatively familiar with this. This is an interesting concept. I'll leave it at that.
The whole school is actually. Yeah. It's a little controversial and it's got a lot of attention.
It's about 5x.
Bill Ackman's a big backer of this.
Wait. TV can't do their story.
Linda McMahon, remember education secretary?
I do remember.
She went from wrestling to education.
We will be in the Hamptons tonight, and we'll be broadcasting from there tomorrow. So we will miss you guys.
You're going to the Alpha School?
I didn't get in.
Yeah.
I wasn't accepted.
Sorry, Tim.
But we're still going.
All right.
No, we're gonna be at Uncharted tomorrow.
Yeah.
We've got some great interviews lined up, so be sure to tune in. The 2:00 hour, you will see us.
Okay.
And we'll miss you for the simulcast.
Will you miss us?
Yeah, we will.
Yeah. It doesn't sound like.
Katie, why are you so quiet?
Because you asked if.
Just taking it all in, man.
Because Katie knows if you can't say something nice, then don't say anything at all.
Well brought up. All right, guys, we will miss you. Have a good Friday and the rest of today.
Yeah, have fun working in the Hamptons tomorrow.
It's hard work, you know.
Yeah, drinking your Hampton
Breeze
water.
in your hair and all that good stuff. Ocean sound in the background. All right, that is a wrap.
too.
Our cross-platform, Romaine and Katie, continuing on the close, of course, on Bloomberg Television. I can hear you. And Tim and I back here on Bloomberg Business Week Daily. We will not see you tomorrow, but we'll see you on Monday.
All right. Don't go anywhere. We need to take a quick commercial break, but we're actually expecting some earnings. This is out of FedEx Freight. We're going to take a closer look at the world of logistics and the broader economy when we come back after the break, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A mixed day on Wall Street. We started off the day with most of the major indices coming out of the gate strong on the back of those earnings out of Micron and that investor day from Qualcomm. While those stocks did manage to hold on to most of their gains, the rest of the market, it kind of got left behind. The S&P 500 finished flat. The NASDAQ composite finished in the red. The Philadelphia Semiconductor, though, index up about 4% on the day, though a little bit shy of the 5% intraday high. And you see the Mag 7 there. We've been talking a lot about it today, particularly with those price hikes announced by Microsoft and Apple because, of course, of the increased cost of those memory chips. The Mag 7 as a group down for a fourth straight day.
Absolutely, and you could see that story really come through when you take a look at the individual level. Micron absolutely flying today, higher by about 15.7%. I put Apple at the bottom of the board, but train your eyes there. Apple shares down about 6% on the heels of those price hikes. Micron, that was your biggest points contributor to the S&P 500 on the upside. On the downside, Apple owned that as well. And it was interesting, even though you saw memory chip makers far and wide rally today, it wasn't necessarily chip makers across the board because NVIDIA falling by about 1.6%, also taking a bite out of the S&P 500.
All right, we're also keeping an eye right now on FedEx Freight. It's relatively new stock, of course, just spun off from FedEx and now reporting its first earnings as a standalone company. Revenue coming in the most recent quarter at about $2.4 billion. Operating income at about $158 million here. There weren't a lot of analyst comparisons out there, obviously, since it pretty much just came to market here. But a lot of people really keeping an eye on this company as one of the more pure reads on what's been going on or what will be going on in the freight space. Joining us right now to talk a little bit more about this is Mark Newton, Managing Director and Head of Technical Strategy at Fundstrat Global Advisors. Mark, great to have you here.
Thank you.
I know we can't make too much of the quarter itself, but give me a sense here as to kind of what your general expectations are for this company as a standalone. Right. And is it in a better position on its own relative to where it was underneath the broader umbrella of FedEx?
Well, look, I think it's always very encouraging if a company can have its own management. The one thing is that FDXF comes into the S&P and the transports being very fully valued as an LTL. It does have some pretty significant debt and fully priced. So the key is going to be similar to FedEx itself, whether they beat earnings and revenues but yet fall short in terms of guidance. They want to watch operating ratios. The real key is to address what Amazon announced just a couple weeks ago with regards to getting into the LTL business, which might be not necessarily a short-term concern, but certainly a longer-term competitive threat to that entire business.
Well, talk to us about that a little bit more, because I have to imagine that was a nasty surprise for this new standalone company. Right. What a formidable competitor in Amazon. Talk us through, I mean, how you see them developing, because like you said, maybe long-term this is a threat, short-term, maybe they still have some room here to future-proof a little bit.
Yeah, look, I think if you look at their peers like Old Dominion, Saia, I mean, many of these have 150 to 200 different centers, and Amazon has, I think, about 17. So the immediate threat isn't really there, but Amazon has already contacted, I believe, about 10% of their customers, and over 60% of those agreed that under the right circumstances, they would, in fact, jump at that. So yet again, you have to keep your eyes open to Amazon. It's slowly but surely, making progress in terms of the competitive landscape. Yeah.
I am curious, though. Do you think there's a possibility we could see some consolidation here, primarily to sort of try to fend off that Amazon threat? I mean, not necessarily FedEx Freight right out the gate will come out with M&A, but I mean, we've seen what Amazon can do when they put their mind to something, right, and they really want to undercut their competitors.
Yeah, look, it's an interesting environment in general. I think it's pretty promising with, we saw inflation data come in, better than expectations. Yields are starting to drop. A lot of the measures point to freight starting to pick up in general. It's anybody's guess as to what exactly they'll be able to do to fend off that threat in the long run. Short term, I'm pretty encouraged in general about transportation and just the general environment. We've seen housing construction stocks really start to pick up measurably in recent weeks. That's a very big positive for the freight sector in general. So I think I'm encouraged about what's happening with transportation. In general, the broadening out of this market recovery, I think bodes well for freight at a time when it should be bottoming out.
Well, related to that, I am curious to hear how FedEx Freight and, their industry peers in general, how sensitive they are to what we're seeing on the geopolitical front. When you think about what's going on with energy prices, the feed through into fuel costs, I mean, how does that sort of impact this sector?
Well, look, I think you can argue that crude pulling back doesn't necessarily always positively affect freight, but when you look at it as being more of a supply shock in general, and rates are now starting to fall on the long end, which is actually contrary to most expectations of inflation picking up. But we know, most of those inflation forecasts are based all in the past. We know that crude having dropped from $120 to $70 in short order in general should be, very good for the consumer. And so that, if anything, is a big positive towards expecting their business probably can be pretty good, I think, over the next year.
All right, Mark, really appreciate you stopping by. That is Mark Newton. He is Managing Director and Head of Technical Strategy over at Fundstrat Global Advisors. Meanwhile, we do have a bit of M&A news here crossing the terminal now that onsemi will buy Synaptics for an enterprise value of about $7 billion. You're taking a look at the after-hours move here. You can see onsemi down about 5% or so in reaction. Not too much of a move either way when it comes to Synaptics, but we will continue to keep an eye on that story. And coming up next, one of the chip industry's top architects joins us to talk what's next for his AI computing company, Tenstorrent, and why current AI tech could soon be obsolete. That conversation with Jim Keller, he is the CEO of Tenstorrent. It's coming up next. This is The Close on Bloomberg.
Revenue from AI at a tipping point, and it may justify the recent spending boom. Research firm Exponential View has found global AI sales, if you exclude China, at about $25 billion for the first quarter of the year. That topped industry's estimated depreciation costs. Our next guest says, though, all the tech driving the data center build out could end up being obsolete. Joining us right now is Jim Keller, of course, a legend in this industry, the chip architect behind AMD's Zen and Ryzen chip, Apple's original A4, A5, iPhone silicon, Tesla's full self-driving, and now the CEO over at Tenstorrent, which is a big focus on RISC-V and an open chiplet-based architecture. Jim, we wanted to talk to you primarily about one big thing. Every day on this program, we look at the balance sheets of all these hyperscalers, all the money they're spending on GPU CapEx. And I've asked this question, particularly as they come into the debt markets, as to what they are sort of underwriting this debt with. The idea that you have chips that might be on a depreciation cycle with a much shorter duration than the actual debt that they're selling. When you look at the chips that are out there right now, what is the lifespan?
Well, that's been a really interesting thing, because it used to be, we'd say, like this kind of data center compute would have a lifespan of 2 to 4 years, and people expected like the H100 build out to really depreciate, but they're still commanding pretty good prices. So the longevity of the build and like how it's monetized has gone further. But that's also partly because of growth and partly because how the market's evolving. The thing I made a point about is if you look at what we talked about for AI 2 years ago, people hardly talk about it. Nobody talks about Llama 7DB, and nobody talks about a whole bunch of models. The models got really big, really fast, really effective, and the big issue is change and what's going to happen next.
Well, give me a sense of what you think will happen next, particularly not just in terms of the type of chips, but the idea of what exactly the AI use cases will be and the type of technology that will be needed specifically for that.
Yeah, it's really interesting. So one of the things that AI is great at is programming. And there's two big reasons for that. One is it was written by programmers and developed to help programming. So that was a really early access. It's also really good at search and summarizing. And again, you can think of that as it was trained on the internet, and it's become really good at that. But as we start to refine the use cases, I think we're going to use it for more science and engineering, more use cases and analysis. I think everybody already knows, I'm sure you guys do this, if you want to go look up what's going on with a certain market segment, you do an AI search first, right? Because it'll give you a good overall sense.
Yeah, no, it's a fair point here. I do want to, sort of game plan out this scenario where you call it these stranded assets, dead silicon, dead data centers that, the world we could be skating into. In your view, I mean, what survives in that sort of system where you do see basically technology advancing and some of the chips that we're working with right now do become obsolete, for lack of a better word?
Yeah, I'll give you two different takes on this. One is it's been very stable for a long time, 40 years, that the computer world's divided into, compute, general purpose computers. We even use the word general purpose. Memory and I/O, like I/O is networking, flash, disk drives. Compute is CPUs, and then memory is all kinds of memory, SRAM, DRAM, flash, right? And then when there's changes in the market, you see a proliferation of new companies and new ideas. The internet boom spawned a whole bunch of network startups. The GPU and gaming boom spawned, I think, 35 different GPU companies. And for a while, HPC generated floating point accelerators, Cray, there's all kinds of computers there. So in the growth phase, there's experimentation, but then there's always consolidation. And I think we'll see the phrase general purpose AI will come up. Because today, everybody's talking about disaggregated AI and specialty hardware. That's a sign of an inflection, but that's not usually the long-term landing place.
So from experimentation, of course, to consolidation, I'd love to hear, how you see Tenstorrent sort of fitting into this picture.
All right, so I think we're one of the few doing real general purpose computing. So it's a balance of memory, DRAM, SRAM, flash drives, compute, and then the networking to hook a lot of processors together. We see the software applications as pretty distinct. So if you look at, the big LLMs versus small video, image, speech to text, they're fairly different applications, but underneath there, we think there's a pretty common hardware method. So we're building software to differentiate, but the hardware platform is actually one general purpose AI computer.
Jim, I do have to ask you just about what your plans are for this company. There's been a lot of talk about consolidation in this industry. Just a few minutes ago, we had breaking news that onsemi was buying Synaptics. There was a report in the information yesterday, I believe, that seemed to intimate that there had been some sort of discussions between your company and Qualcomm.
Sure. Our mission right now is we're going to grow. Like, we are building computer, we're in production, we're driving volume. We're really interested in the high value end of the AI token segment. So that's large LLMs, pre-filled decode, large video models, really fast acceleration. We see a big opportunity there. We think that's where the most value for our company is. We also think that's the center of the general purpose compute and general purpose AI that's coming. We're interested in partnerships, and we'll see what happens.
But with regards to just the standard that you're using, obviously it's a more open standard relative to what we know NVIDIA is making. Are you trying to go directly up against NVIDIA, or are you trying to sort of be complementary to it?
the market's really big, and people asked, for a couple different things. Our AI software stack is open sourced. Our both AI processor and support processor is built on the RISC-V architecture, which is open. We actually use an AMD processor as our host node in our Galaxy server. So we're pretty flexible about the compute architecture. But the openness, the best models in the world today, many of them are already open source. And having the software stack itself be open source is a complement to that. And people want to own their compute, and they want to pass this, sovereign AI. And so that's the business that we're in.
All right, Jim, really appreciate your time. That is Jim Keller. He is the CEO of Tenstorrent. Meanwhile, coming up, we're going to talk about a different type of consolidation. H.B. Fuller striking an $870 million deal set to acquire UK-based Advanced Medical Solutions. CEO Celeste Mastin joins us next. This is The Close on Bloomberg. U.S. adhesives manufacturer H.B. Fuller agreeing to buy Advanced Medical Solutions. It's a British maker of tissue healing products for $870 million. H.B. Fuller CEO Celeste Mastin saying the deal is, quote, the best way to increase value for shareholders. And I'm pleased to say that Celeste joins us now. Great to have you with us. So this is your largest acquisition since 2017. So 9-10 years here. Talk to us about what you saw in AMS that, you couldn't necessarily do at home organically.
Yeah, thanks for having me, Katie. So we are the largest pure play adhesives company in the world, and we have a medical adhesives business deep within our portfolio. What AMS provides us is a platform to expand that adhesives business and set it apart as a fourth division within the company, representing about 10% of revenue and growing at high single digits. So really giving us that growth spark we need to demonstrate to shareholders that we are moving our portfolio into the higher margin, faster growing spaces within this industry.
And I do have to ask a little bit about some pressure you've received from an activist investor, Encore Holdings, because they had been pressuring your company to abandon this proposed takeover. They've threatened a proxy fight. Now that the deal has been announced, it's gone through. I mean, what does your engagement look like with them?
Yeah, so Katie, we're doing exactly what we said we would do. We're growing in our medical adhesive space. And this is something we promised our investors during our investor day last October. And we've been speaking to this direction for years now. And, we don't comment on conversations with any individual shareholder, but actually now that we have been lifted from the UK takeover code rules, we're having a lot of conversations with shareholders to share with them more about this exciting portfolio that AMS brings and our deleveraging plan post-acquisition.
Mm-hmm. Well, talk a little bit about that, because I think there are a lot of people that are still looking at the balance sheet and wondering how much more progress, or I should say, when we're going to see more progress on that.
Yeah, so as you know, Romaine, so our target leverage range is 2.5 to 3 times. And when we consummate this transaction later in the year, we'll be solidly in that range. It will lift us out of our target, and we have shown in the past that when those occurrences happen, we're able to deleverage consistently, normally about 0.5 turn per year. So over the course of the next 24 months, we'll be bringing that leverage back down in range. And, we're acquiring a company that's got really great cash flow, free cash flow conversion. We are increasing our cash flows. We had a record cash flow in second quarter, in fact. And so as we continue to increase our cash flow through some of the restructuring programs we're working on, we also believe that we'll be able to bring down that leverage perhaps faster than the 18 to 24 month time frame.
Well, give me a sense here, too. I mean, yes, you did have that record number on the cash flow side in the most recent quarter. We should point out, though, sequentially the quarter before that, though, not so good. So the question is what we saw in the most recent quarter, is that a one-off or is that sustainable?
No, our first quarter is always our lowest quarter cash flow. And we've been taking some steps, Romaine, over the last year or two to announce a large restructuring plan. We're reducing the number of plants in our network from 82 down to 55. So a significant move there. That's driving not only lower cost and better cash flow, it also lower our CapEx utilization as well.
All right, Celeste, we have to leave it there. I really appreciate it. Got to get you back. Celeste Mastin there, CEO over at H.B. Fuller, fresh off the agreement to acquire Advanced Medical Solutions for roughly about $870 million US. We do have some breaking news. This coming from the New York Times. This on OpenAI, this on its planned IPO. According to the New York Times, they're saying that OpenAI is now leaning towards waiting until next year for that IPO. Katie, that's the redhead crossing the terminal. Again, this is coming from the New York Times, citing people familiar with the situation that their reporters have spoken to, saying that basically it has hired the bankers and it has hired the lawyers, but right now it is now looking more towards next year to actually get this out of the gate.
This is really interesting because you remember when they filed confidentially earlier this month, the company said at the time that we have not decided on timing yet. It may be a while because there are things we want to do that are likely easier as a private company, but it's a complicated set of trade-offs. This gives us the option to go public. So piecing that together with this reporting from the New York Times, it looks like they're leaning again towards the new year for this IPO.
And one key data point or detail in this New York Times story, citing a person familiar with this situation, is they're saying that apparently OpenAI's advisors presented the company with the option of waiting until 2027 to go public with a $1 trillion valuation or go now with a lower than targeted valuation for a quicker IPO. Apparently, Sam Altman, according to this report, has opted to wait.
Well, we'll continue to follow this story, of course, as we watch that three-horse race, really. SpaceX, Anthropic, OpenAI, those were the big ones. Some interesting news coming from the New York Times. This is The Close on Bloomberg. A new twist in the race to succeed Jamie Dimon. JPMorgan's consumer banking chief Marianne Lake set to retire, long considered a frontrunner in the succession battle. Doug Petno and Troy Rohrbaugh named as co-presidents in the shuffle, with our next guest noting that those roles have historically served as the springboard for the CEO job. Chris McGrady, he is head of U.S. Bank Research over at KBW. He joins us now. Chris, give us some context here. I mean, how surprising is this news since, as I mentioned, I mean, Marianne Lake, again, long seen as the successor potentially to Jamie Dimon?
Well, thanks for having me back. Succession planning is very important, in particular for JPMorgan, given Jamie's success over the last 20 years. The good thing is the bench is very deep. As a sell-sider in the investment community, we know the bench very well. They've brought themselves out to meet with investors and analysts over the years. And so Marianne leaving is certainly a loss for the company. She's tremendous, but the bench is very deep.
Yeah, the bench is deep. That's sort of on display today here. And I mean, you think about, though, the role of Jamie Dimon. I mean, he's synonymous with Wall Street. You think of Wall Street, a lot of people, that means thinking of Jamie Dimon. So you think about the shoes that potentially a Petno or a Rohrbaugh would have to fill. What do you think would differentiate one or the two of them as, we watch this succession race continue to take place?
Well, first off, there's no one that's going to replace Jamie. He's one of a kind. But having said that, the bench between Troy and Doug, they both bring very good skills leading the corporate investment bank, trading, historically investment banking. So they bring really great knowledge of the business. And again, Jamie and the team has historically surrounded themselves with great talent. Marianne, again, was CFO for many years. She transitioned into the community bank. Again, that community bank is delivering a 30% return on equity. So multiple people can wear multiple hats, and I think they'll get it right.
Yeah, I am curious about that, too, because, I mean, this is always sort of the issue, right? We talk about some of the messy CEO transitions we've seen. Obviously, Morgan Stanley just pulled off one, I guess, relatively a little bit less messy. Chris, does it, for investors, though, I mean, I know Jamie Dimon is irreplaceable here, but one of the sort of legacies I think that Jamie Dimon has built, and it seems like a lot of folks agree, is that this is probably a company that can not only stand on its own without him, but thrive without him. And obviously, that will still depend on who's at the helm post him. But do you have that confidence?
Absolutely. I mean, the company is the best in class. Their return on equity target of 17%. They continue to exceed that, roughly operating at 20%. And again, this company is delivering top-notch returns, and they're also investing at a level that no other financial institution is doing today. They're spending $20 billion in technology today. So Jamie, absolutely at the helm, has been a big piece of the success. But down the funnel and down the company, the ROEs across the business are tremendous. And what we like about it is we think they're sustainable.
I am curious. I know in a few weeks, or maybe about 3 weeks or so, we're going to start to get earnings out of JPMorgan and the rest of the big banks. We've already kind of gotten a sense, certainly on the trading side, that it's probably going to be relatively good. I think we can also glean, even without knowing internally what the numbers are, M&A, advisory, all that should also be well if you sort of count what we've seen in the markets over this year. Are you relatively optimistic, not only about JPMorgan's earnings report, but really for all of the major U.S. banks?
We are. We think the largest banks are very well positioned, right? They're capitalizing from a capital markets recovery that's very strong. Trading's proven to be very resilient. Investment banking, the pipelines are at record levels. It's broadening out. Down to traditional commercial banking, loan growth is picking up. There's signs of loan growth. Credit quality is very good. And so the industry is set to put up very good results. Now, the question is, are they sustainable? We think they are. We still have a preference at KBW to own the largest banks, JPMorgan, Citigroup, Bank of America, Morgan Stanley. These are some of our top picks. What we like about these companies is they've built resilient models, and the returns are very consistent. And so over time, these businesses have become more valuable, right? When I started my career over 20 years ago, the largest banks traded at 8 times earnings. Today, they trade at 15. And so we think because the ROEs are so sustainable and because the moat around their businesses are so great, these are the stocks you have to continue to own.
All right, Chris. Well, I'm sure we'll catch up with you in about 3 weeks' time when we start to get those results. Chris McGratty there, head of U.S. Bank Research over at KBW, with a little bit less focus on the financial picture of the company and more on the leadership with Marianne Lake out and the elevation of 2 others, and a lot of questions about when, if ever, Jamie Dimon will move on. All right, when we come back here on The Close, we're going to go from business leaders to the institutions that shape them. We're going to have a sit down with the Chancellor of the University of North Carolina, Chapel Hill, and his bold build-out plans for the university system. That conversation coming up next, right here on The Close. All right, let's talk the world of higher education. The University of North Carolina is the oldest public university system in the United States, dating all the way back to 1789. Just about 2.5 years ago, the University of North Carolina at Chapel Hill got a new chancellor. He had no background in education. He came from Wall Street, actually, Morgan Stanley, private equity. But he's got big plans for the university. He wants to expand the undergraduate student body by as much as 25%, build out athletic facilities, add housing to handle the influx of students, and, well, he's got a lot of people backing him and a lot of critics as well. I had a chance to sit down with Chancellor Lee Roberts to get his take on what he sees as the future for the University of North Carolina.
It's about 25% growth in our undergraduate population. But look, the state of North Carolina is growing so strongly. You want to feel old, I'll tell you that our incoming freshman class is the class of 2030. And by 2030, North Carolina will be the 7th largest state in the country. So we can't grow as fast as the state grows, but we have an obligation to grow as fast as we can grow to try to reflect the enormous growth of North Carolina.
When it comes to the prosperity of the UNC system, though, is population growth, student population growth, does that get you there? Is that fiscally prudent to pursue that track rather than something maybe a little bit more leaner?
Well, we'll take 10 years to add those 5,000 students because there are implications everywhere you look for housing, dining, parking, our large lecture classes. So we need to add the infrastructure as we add the new students. But we already have 1,000 additional students between last year's freshman class and this incoming freshman class. So we're well on our way.
I am curious about your background. Morgan Stanley, private equity, you ran the North Carolina budget for years, and now you're running the university system. I am curious as to what your approach is to running UNC. Are you running it the way that you would run your private equity fund, the way you would run your business at Morgan Stanley, the way you would run it as a government official?
You can't run a university like a business. The incentives are all different, and the goals are different. We've been around for 232 years because we have this profound sense of public mission. We're not trying to meet a quarterly profit target, but there are some things we do at the university that could be done in a more efficient or business-like manner, and we do think a lot about making sure that we're using our resources as effectively as possible, which is obviously important as a public flagship.
Like what? Can you give me an example?
Well, for example, we're highly decentralized, and so we're replicating our HR functions, our IT functions in a redundant and inefficient way across our campus. We can do a better job centralizing those functions, running them more efficiently, providing better results at the same time.
Does that mean you need fewer staff, fewer faculty?
You know, I think we probably do need fewer staff over time in functions like HR and IT. We've already done a lot through attrition. I'm not sure we need fewer faculty. I think we need more faculty as we increase our enrollment and as we try to serve the huge demand that we see for some of our most popular majors. Biology is a good example. It's our #1 major and our fastest growing major.
As you sort of look at the cost equation for the school, on the academic side, on the administrative side, there are a lot of people that are also going to look at what's been going on the athletic side. And we put the asterisk that those are two tracks, both legally and ethically, for a lot of reasons. But when you look at the amount of money that the UNC spends on the athletic program, the amount of money that it might spend going forward with regards to the renovation or maybe the building of a new stadium, et cetera. How do you square that circle for those folks and for those taxpayers who look at that and wonder about that disparity?
We have a really proud tradition in college athletics, 28 sports. We were just in the finals of the national championship for baseball in Omaha earlier this week. And we've been competing in intercollegiate athletics at Carolina since 1888. So it's an important part of who we are. But right now, college sports is broken. It costs way too much. Nobody designed the current system. It all came about as a result of court rulings. And so we think there's a need to bring some harmonization and rationality to college athletics.
But a lot of those court rulings, I mean, they came out of at least the perception by a lot of the players that the way that the NCAA had run things for years was inequitable to them. Is there not equity now based on what those court rulings provided?
I'm not saying every one of those rulings was wrongly decided. I'm saying that their collective impact has created this patchwork that doesn't really make sense when you're trying to run a top-tier college athletics program. We really need some more structure and predictability.
There is a bill trying to work its way through Congress right now, sponsored by Maria Cantwell and Ted Cruz, that does look like it has bipartisan support and maybe potentially could actually make it to the floor for a full vote. Do you think what they're proposing, which would largely create more of a federal umbrella that would sort of address your patchwork issues, do you think that has a chance of actually being passed and becoming law?
We've endorsed that legislation, as have many of our peers. It's not perfect, but no high-profile bipartisan legislation is ever going to look exactly the way it would look if you could write it yourself. We're optimistic about it. I think the White House is supportive. So we're hopeful that that can get passed to make a difference.
You think that would fix the economic issue going on right now that we've seen sort of unfold since those things, or does it just solidify sort of the big dogs and their advantage that they have over the mid-tier and smaller schools?
No, it would make a big difference in creating more predictability and transparency as we try to run college athletics in any kind of reasonable way. Just the ability to enforce eligibility restrictions, transfer restrictions. I worry about us losing our connection to our fans if college sports stop looking like college sports. And the Cruz-Cantwell legislation will help us protect college sports.
But then a lot of people would look at, they look out the payout that you had to make to your former basketball coach, the huge pay package for Mike Malone, the new basketball coach, Bill Belichick on the football side. I mean, they are compensated handsomely, probably deservedly, and what would the players have with regards to being commensurate with their skill level and what they contribute to the school?
Nobody's saying let's not pay players. Pay for players is here to stay as it should be. But the Wild West that we have right now, where payrolls are increasing by 20, 30, 40% year over year, players don't know what the market is. They're being taken advantage of by agents. There's no cap on agent compensation. We have players show up with multiple agents. It really is a completely unpredictable situation right now that I don't think is serving anybody particularly well.
Can I ask you about Bill Belichick?
Please.
Didn't start off too well the first year. Are you optimistic about what we're going to see come this end of summer, beginning of the fall?
Really optimistic about the season. Great job recruiting, great job in the transfer portal. We kick off the season week 0 in Dublin against TCU, which should be a lot of fun. They got us in Chapel Hill last year, so we're looking forward to the rematch in Dublin.
And that is Lee Roberts. He's the chancellor over at the University of North Carolina at Chapel Hill. Part of that conversation. You can catch the full conversation by going to Bloomberg.com/videos. A wide-ranging conversation there, not only about the higher education system, but he had some very strong views about some of the changes that have occurred in college sports with regards to paying players and the patchwork system, as he calls it, that he wants to see maybe smoothed out a bit.
Yeah, particularly when it comes to college sports. I mean, it's a fascinating time. You think about the impact of NIL and all of that. Certainly a wide-ranging conversation you had.
And not like UNC. I mean, they'll be okay. They're the big dogs. Now, Haverford, I don't know. They get a little, a little there. Though. Anyway, it was an interesting conversation. And he's, like I said, he's only 2.5 years on the job there. He's got a lot of critics, but he's got a lot of supporters, too, and just trying to sort of help that school grow. Meanwhile, we're wrapping up our coverage here on The Close on this Thursday afternoon, a very consequential day for markets. As far as what's on the calendar tomorrow, Katie, I guess we're going to start off at 8:30 a.m. with wholesale inventories.
Yeah, a lot to dig into there. Really interested, though, to see at 10 a.m. we get University of Michigan sentiment. The sentiment figures themselves interesting, but also going to be good to look at the inflation expectations among consumers as well.
Absolutely. We're also going to hear from Minneapolis Fed President Neil Kashkari. He's participating in a panel on affordability. It's going to be moderated by Lisa Abramowitz, of course, the co-host of Bloomberg Surveillance. You don't want to miss that. You don't want to miss Katie and I tomorrow right here on The Close as we break down all of your market-moving action. And if you're into politics, that kind of thing, stick around. Joe Matthew, Kaylee Lyons are up at the top of the hour with Balance of Power right here on Bloomberg.